Hello, I'm Brian Beaulieu from ITR Economics. Thank you for joining me for this edition of FedWatch. Today is February 16th, 2024. Several important data series came out this week, one of which was the CPI. There are some aspects of the media tended to make a big deal out of it. Truth is that the 112 rate of change eased downward to 3.1%. So it just didn't go down as much as the pundits expected or the other experts thought it would, but it's on track with our expectations. Core inflation remains higher at 3.9, and that's because what's helping with the overall consumer price index is that food is up only 2.6%, energy is down 4.6%. So overall inflation is actually better than this core inflation. And nothing's much changed in terms of what's driving this. It's wages showing up in the way of when you go to a restaurant, that's at 5.1%. Automobile transportation services, whether it's getting insurance or getting the car fixed or taking an airline flight, that's running at about 9.5% year-over-year increase. Medical is nothing. But shelter remains still problematic at 6.0%, which is rent and rental equivalency for people who own their homes. So, we're not seeing any dissipation in the core problem areas, not core inflation, but those service-oriented areas. Retail sales also came out. That was strong in January in both nominal dollars and adjusted for inflation, at least using the CPI. The 12 call rate of change shows 2.8% year-over-year rise in the 12-month moving total. So with an inflation rate of 3.1 in the CPI, the retail sales up 2.8, you can see it's not really keeping up with inflation, although the headline numbers looks pretty good. There's some encouraging things. The seasonal change from December to January, which is decline. January, you expect to see a decline. It was milder than normal. But the 3-month moving total is slightly below average in its onset of seasonal decline, so a little bit weaker than average relative to post-Great Recession history. So mixed results there, nothing terribly bad. It gets a little bit worse when you look at general merchandise stores. That was up only 2.2%, so even further lagging behind the inflation numbers. So there's some softening out there, but it certainly is holding on better than we thought it would, with credit card balances running at $7,000 a month and costing 21% interest on a per annum basis. Manufacturing continues to be weak. It's in a very gradual, shallow decline. It's milder than average decline in the data trend, 12-month moving average, but it is normal. And January came in 0.7% below 1 year ago. And the 12-12 rate of change is also 0.7% below 1 year ago. So very gradual softness there, nothing that's going to, we think anyways, turn into a nasty rout anyways. The PPI came out also this morning, and I was on a plane when it came out, and I'm watching the headlines, and they're making a big deal out of acceleration in the producer price index. So as soon as I could, I got on my laptop, checked the numbers for myself, and I don't know what they're talking about in terms of acceleration. I wish I could tell you that I saw the same thing. I didn't. The 112 was at minus 1.1%, and that means there's deflation going on in the PPI. The 112 rate change has declined to 3 out of the last 4 months. Last month, the 112 was minus 0.1, so going to minus 0.1 to minus 1.1 in 2 consecutive months like that. There's no acceleration to speak of. So I would just ignore that aspect of the news if I were you. And the last little bit of news was housing. Single-family housing starts are following after the permitting trend, and the 312 for starts now, not just permits, is at 26+% increase year-over-year for the last 3 months. The 12-month moving average, or total rather, is rising. It's up 8.3%, which is a little bit faster than the median increase. So it's a good rise going on in housing. What's the Fed going to do with this? Nothing right now. They're going to wait for some more data to fall. We need to keep in mind when you're watching this data that housing is telling us about what's going to be happening more like late 24 or 2025. And the CPI and the producer price index, they're lagging indicators. And retail sales tends to be a coincident indicator. So housing's already gone through its slump. Retail sales is showing a little bit of softening around the edges, and the prices are just now beginning to move down more noticeably. I don't think the Fed's going to do anything before May. Uh, they've been making noises that it'll be sometime this summer, which would technically mean in June or even July before they start lowering interest rates. I expect the stock market's going to be excited and then depressed as more data comes out. But for right now, we're thinking hold off on leveraging, whether that's for a mortgage or for your business. We're going to see lower rates about a year from now and on into early 2025, a couple of more months into 2025 anyways. So there's no need to rush right out there. These interest rates are going to be coming down. Bide your time, make sure you've checked your cash flow. Thank you for watching this edition of FedWatch. I'll see you next week.